We are continuing our topic of partnership changes, and we are looking at the example question Layne and Hart. And I guess some persons were supposed to start. There were certain things that you were supposed to do. So persons were supposed to do the revaluation account. Jonathan, did you see my message or no? Unless I have the wrong number for you. Jonathan, you're here?
Yes, miss.
Did you see my message? Unless I have the wrong number for you.
You might got the wrong number.
Probably did. Probably changed your number.
And I changed my number, don't I?
Well, I sent a
From the
message.
last.
I sent you a message last night. WhatsApp.
Yeah, what that?
Yes, please.
Give me a second.
Telling you that giving you feedback. So you're online right now. Yep. Letting you know that I looked at your Layne and Hart revaluation account. But unfortunately, you had placed yours, it was you and another student, had placed yours in the box under Unit 1.
Yeah.
Right.
I see it, man. I see it. No
Right.
what happened.
So you had placed it under the box in Unit 1. So therefore, when I pick up the revaluation accounts for the other students, yours were not, you and the other student weren't in the count. So it's when I went to the box, I saw it. So I gave the feedback last night. Right. So this is what we're looking at today. And I think it's Naisha. Naisha has a question before we start. What I'm going to do, I am going to place the revaluation account in the spreadsheet so you all see it. I'm going to place the Goodwill account as well, and we're going to start those capital and current accounts as well. So Naisha, go ahead and ask your question, please.
No, ma'am, I just want to see how it would be, because I don't think I put it with the right number in the right place. When I was starting it, I don't think I put it the right place.
So when you say you don't think you put it in the right place, what you would have done when you were doing the Goodwill account?
Yeah, I can put out the question.
Okay. And remember that, as I said, I hope everybody has a question. I want to say welcome to Aaliyah Gill. So Aaliyah, make sure your mic is working and that you ask your questions.
Yes, ma'am.
Right. So the question that we're looking at, I hope you would have been able to watch the recordings during your absence. And the question we're looking at is Pamela Layne and Sue Hart. So this is the question here. So hope that you have that question as well. And I want everybody to make note of what are the conditions for the old agreement and what are the conditions for the new agreement. So you need to make note of that. So remember, one of the first things we stated was that you need to know the date of the change, because the date of the change helps you to calculate your information correctly in the income statement and statement of appropriation. And also knowing what are the conditions for the old agreement and what are the conditions for the new agreement also helps with your calculations as well. So if you don't know those, that will give you some trouble. All right. We had the revaluation. So the assets were revalued, land, building, you had stock, and you had debtors that were owned that went bankrupt. So we say when we were looking at revaluation, we were looking at all of this information here, just in this area here. Goodwill goes on its own because there is a Goodwill account. And they said Goodwill was valued at $28,000, and it was agreed that a Goodwill account would be maintained in the books of the partnership. So now you should go ahead, tell me what you would have done for Goodwill.
Ma'am, I debit the 28,000 on the Goodwill side, and I put capital. So when I go to the capital account, it can only be one, right?
Mm-hmm.
So the both partners can get one.
So you put 28,000. You debit Goodwill for 28,000, and then what you do with the capital account?
Right, that's where I was getting confused because I didn't know if I was supposed to put it, if it'll be one for capital account, if both would get a part of it.
But that is what we said when we looked at Goodwill, because we said, if you go back to the video, and even if you look at, let's see if I find the presentation. If you look at the presentation that is online, the presentation states that Goodwill affects the partners. So it states that the Goodwill, because Goodwill, they said when Goodwill, where is it? Looking for the exact thing. The Goodwill affects the partners. So because Goodwill is affecting the partners, then it must be shown in the capital account of the partners. So it says, slide, trying to find out which slide this is. I'll make sure I have my slides mixed up. So let me make sure, so I can tell you the slide number when you are looking at the note. Slide number 5 says Goodwill can be recorded for any type of businesses, which is sole traders, partnerships, limited companies. It affects the owners of the business. That's what it states, that Goodwill affects the owners of the business. Therefore, the capital accounts of the owners must reflect the change due to Goodwill. So if Goodwill is affecting the owners of the business, their capital must reflect that change with respect to Goodwill. And it said Goodwill is an effect of changes in partnership and must be incorporated. So it affects the owners, and it tells you, and then remember I would have shown you all this note that you all have online. So you have a PowerPoint, and then you have a whole set of other notes. So this is a note on Goodwill as well. This note is on revaluation and Goodwill, not just revaluation, but it's on Goodwill as well. And it says Goodwill can be accounted for in 2 ways. It could be maintained on the new partnership business books or not maintained in the new partnership business books. And it said Goodwill maintained, the Goodwill is created and shared to the existing in their profit sharing ratio, right? So we are going to look at those 2 things. So let me look at the revaluation, and then we will look at the Goodwill. So let me do those 2 accounts, because I want to make sure that we have our debits and credits. So we have here, so we're going to look at revaluation and then look at Goodwill. And then we are also going to be doing the capital account at the same time. So, Layne and Hart, this is our solution. This is where we would have started last week, Friday. And Friday we would have come up with the split. And persons would have said that the old agreement is from July to October, which is 4 months. And the new agreement was from November to June, which is 8 months. So please remember to do that when you are doing these questions, right? So I have here a tab that says Goodwill and revaluation. So let's look at the revaluation. The first asset we're revaluing is our land, which was in the inside of the trial balance. Land was $100,000, and the land was on the retirement of Hart. The land was revalued to $108,000. So that's a difference of $8,000. So that means the land account is going to be debited for $8,000. So the revaluation will be credited for $8,000. So we said that. And then we had the buildings were revalued as well. Buildings in the trial balance was $54,000, and they were revalued downward to $49,000. So the difference was $5,000. So that means the revaluation account is debited. So buildings for $5,000, and then the buildings account would be credited for the $5,000. Then stock was worthless. So if the stock is worthless, it must be removed from the books. And it was $800 that was of stock that had no value. So that has to be removed from the books by debiting revaluation for the $800 and crediting the inventory account. Then also they stated debtors own $1,100 were declared bankrupt. So if they're bankrupt, you're not going to receive that $1,100. So therefore you have to remove that $1,100 from the debtors account. So you debit the revaluation for the $1,100, and then the debtors account is credited for that $1,100. So when we look at our information here, we see that the credit side is $8,000, and our debit side is only $1,100. So our debit side is only $6,900. So the difference, so you have to find the difference. So that would be $8,000 minus $6,900, and the difference was $1,100. Difference between the debit and the credit side was $1,100. So, and we said we stated that when the credit side is greater than the debit side of the revaluation account, there is a gain on revaluation. So therefore the revaluation account is debited, and the capital accounts of the partners will be credited for that gain. So you have capital accounts, and that would be for Layne and Hart. That's what we say, that it is Layne and Hart and not Layne and Brown. So it's Layne and Hart, because these were the partners that were part of, these were the partnership when the assets were being revalued. Hart Brown is now coming in. So we said it's Layne and Hart, not Layne and Brown, not Layne, Brown and Hart. It's just Layne and Hart. So then you will split this $1,100 here in their profit sharing ratio. And the question stated Pamela Layne and Sue Hart have operated a partnership business for several years, sharing profits and losses equally. So they were sharing their profits and loss equally. So that means they have to share this gain equally. So $1,100 times a half, which is $550. And then for the same thing goes for Hart. $1,100 times a half, or just subtract one figure from the other, and that's 5. So then when you do your additions, you are going to get $8,000. This the debit side and the credit side, $8,000 each. Right? So this is the revaluation account for Layne and Hart. We're going to look at the Goodwill. Before we look at the Goodwill, let's look at the capital account for Layne, Hart, and Brown, because you have to account. So we can't just do the capital account and don't put Brown, because Brown is going to be coming in. So we have to put a column for Brown as well, right? So this is Layne, Hart, and Brown. Right, Layne, Hart, and Brown. So we have to start our capital with the opening balances. Balance brought down. So when you look back at your trial balance, you're going to see a column that says capital accounts, July 1st, 2012. You have Layne, $65,000. So the balance for Layne is $65,000. For Hart is $62,000. And remember, Brown came in on November 1st. And then in the question, it will tell you that Brown invested cash. So we can always put here cash, $5,000 for Brown. That's what we can do for Brown. And just now, the revaluation account was debited with a gain or a profit for Layne and Hart. So now we're going to credit the capital account for that gain. So it's the revaluation for Layne and $550 for Hart. So this is how it goes into the capital account. So what that person would have done this so far with the capital account. At the same time that I am here, we are going to start our current account as well. So Layne, Hart, and Brown. And we're going to put in the balances in the current account. So let's go back to the
after the cash. You got 75,000 when they
for
say here
Brown.
cash them. Oh,
For Brown.
I see what you mean.
Right, because it's number one said Brown invested $75,000 cash as capital. Right.
Right,
So,
understood, because I was looking at the trial balance. That was
right.
my bad.
That's no problem, but it's already there in the trial balance, which meaning in your cash and bank figure is already included in that cash and bank figure there as well. So once it's in trial balance, it means it has already been recorded. So I just put it in there, $75,000, right? Remember, he was not there from the beginning of July. So he was not there from the beginning of July 2012. So remember, these balances here are from the beginning of July. So I don't want to put him up here as a balance brought down, because she was not there at the beginning of July. She came in here in November. So these balances here, if I had to put a note, these balances here are for July 1st. These are the balances, the opening balances at July 1st for Layne and Hart, because they were there at the beginning, right? But then you have here, she came in November. So if anything, this will be November 1st, right? So you don't have to do this, but I'm just saying that this is what is occurring here, right? That this is, these are the balances at July 1st. So I cannot stick Brown up here at July 1st because Brown was not there at July 1st. And then these here are for she came in November, so I will just put her there for November, right? So thank you, Chloe. Let's look at the question for the current account. In the question, we go back here. So we were talking, this is what we were referring to the capital accounts. July 1st is Layne and Hart, 65 and 62. But then Brown is November 1st, 70, and that is 75,000 for Brown Deer. So then we come to the current accounts here now. The current accounts at July 1st, at the beginning of the year, is Layne. Layne has a debit balance of $800 and Hart has a credit balance of $4,200. So you will realize that Brown is not listed there with current account because Brown was not in the partnership before. So because Brown was not in the partnership before, Brown cannot have a current account at the beginning of July, right? She cannot have a balance on a current account because she was never part of the partnership before. She is coming into the partnership in November, so we will be now creating a current account for her. So what we can do at the beginning of July is enter the opening balances for Layne and Hart only. And then as we go through the question, then you will see that Brown will start coming into that as well. Don't forget to answer your questions as you go through.
So, ma'am, basically, in the format that you have it sorted out as you have Layne, Hart, and Brown, you just put it all in one instead of separate for this time
Yes.
and that time. Oh, okay.
Yes, because that the current account and the capital account are prepared. We prepare them in this columnar format. It still is drawing one T account for Layne, another T account for Hart, and another T account for Brown. We draw one big T account and put each person in a column. At the same time, it's still representing a separate capital account for each person and a separate current account for each person. It's just that it looks like if it's in one place. That's all.
Understood.
You're welcome. So you have here and I think that is Layne has a debit balance of $800 on her current account, and Hart balance bought down. Hart has a credit balance of $4,200. So we can put in those, right? So we've dealt with that. Let's go back now to Naisa's question with Goodwill. So when we are looking at Goodwill, we said that the question stated that Goodwill was valued at $28,000, and it was agreed that the Goodwill account will be maintained in the books of the new partnership. Your note and the presentation that I would have done states that Goodwill is an intangible asset, meaning it's something that cannot be touched, and created from the business being a going concern, meaning that you expect the concept of going concern, you expect the business to continue into the foreseeable future. So you get the Goodwill because you expect the business to continue in the foreseeable future. It also states it is the additional value that the buyer is willing to pay for the business's net assets greater than the book value. So we also stated there were reasons for Goodwill, because some of the reasons for Goodwill, you have loyal customers, you've already built a good reputation with suppliers, you have very reliable and efficient staff, your business is located in a very good location, you have you have well-known brand names, etc. So these are reasons why this business may have Goodwill, because if Brown had to start a business now, she would have had to look for all of these things and create these things. So you have some Goodwill for this business, and the goodwill was valued at $28,000, and they said that the account is going to be maintained on the books of the business. And again,
Ma'am,
yes, please.
wait, not to cross you, but Flo on Danny power link and she electricity gone off. So she don't know when she will be able to come back in the class.
Oh, Miss Quickslow,
Yes, please.
no problem. All right. Okay. All right. Thank you, Jessica. The teacher was answering a question. Oh, Julia was asking a question. She said, "Hi, ma'am. Since Hart retired, the goodwill will be shared between Layne and Brown." And Natisha responded to Julia. Thank you, Natisha. Because Julia had a question, and Natisha responded and said, Julia, existing means all partners. So Julia, Natisha is correct in that the goodwill is, as long as it is, the account is being maintained on the books of the business, the goodwill is between the all partners, which is Layne and Hart. If the goodwill is not maintained on the books of the business, and that was done in the PowerPoint, sorry, in the presentation, the video. This is where it said, watch the video, and then when you come to the class and you have any questions with respect to something you didn't understand from the video, then you can present that in class and get further explanation. So I don't know if everybody would have watched the video, but whenever, and then not only watching the video, but then this note here that I refer to as well, that you have online. This note states goodwill can be accounted for in two ways. You can account for goodwill by maintaining an account on the books of the business, or you can account for it when it is not maintained as an account on the books of the business. And we demonstrate both ways how it is done. So in this case, this question with Layne and Hart stated that the goodwill account will be maintained in the books of the new partnership. So let's look back here. Let me see if we could pull back the PDF with that. Here, it states here, goodwill, a goodwill account will be maintained in the books of the new partnership. So because it states that it will be maintained of the books of the partnership, we have to look at this note that deals with accounting for it when it is being maintained on the books of the partnership. And this note also tells you what to do when it is not maintained. And let me pull up that note as well. Let me share that with you. This is the note here dealing with partnership changes. And it tells you here when the change occurs, the existing old agreement comes to an end and a new agreement is created. At the point of the change, the business must be realized at its market value by revaluing the net assets, which is assets minus liabilities, if the persons don't remember what net assets are, by revaluing the net, and they said at the point of change. This is why the revaluation account only deals with the old partners, okay? And then the second thing they said, valuing the inherent asset of goodwill, okay? Valuing the inherent asset of goodwill. And this here affects the old partners if the account is being maintained, and it affects the new partners if it is not maintained. So it affects both sets if it is not maintained. So if you look here at the note that deals with goodwill, here, goodwill maintained. Goodwill maintained. The goodwill is created and shared. Look, read carefully. The goodwill is created and shared to the existing partners. The word partners is missing, but is to the existing partners in their profit and loss sharing ratio. The share of goodwill is credited to the partner's capital account. So this is how it's done here. So when you're doing the goodwill account, that $28,000 here, this $28,000 that they have here for goodwill is going to be shared with Layne and Hart only. This is who it's going to be shared with because it is being maintained. It's going to be shared with Layne and Hart. So you have to debit the goodwill account for Layne and for Hart in their profit sharing ratio, which is equally, and then the goodwill account has a balance carried down, and then you're going to credit here Layne and Hart. So Layne and Hart will be credited with the what you would have debited here in the goodwill account. Any questions with respect to that? Anybody lost? Then let me have to call your name.
Ma'am, you could go over it one more time.
Tell me what you don't understand that you would like to go, want me to go over. This is Kian or Aaliyah. See person? Okay.
No, ma'am, it's Kenya.
It's Kenya? Okay. Can you tell me what you don't understand? Are you not sure? Hi, Kenya. Come on.
Sorry, ma'am, I was sneezing. I'm not sure.
Oh, somebody else was saying something. So, okay, I can use the other person I was speaking just now.
No, it is somebody chatting to repeat the whole thing.
Oh, somebody tell me repeat the whole thing. Let me see who is in chat telling me repeat the whole thing. Oh, Rakim. Rakim want me to repeat the whole thing again. Okay. All right. So we're seeing here that when the goodwill account, when we say the goodwill account is maintained in the books of the business, it means that that goodwill account will have a balance on it. So it will end up with a balance carried down. And then because there is a balance on the goodwill account, it means also that in your statement of financial position, you are going to have a line item called goodwill, because anytime the account has a balance, long as an asset, as long as there is an asset, a liability, or capital, once them have balances, they are part of your statement of financial position. So that is why they talk about maintaining in the books of the business. So we are seeing that the goodwill account, once it's maintained, you debit it to the oil partners in the partners profit sharing ratio. So you debit the goodwill account to the partners in the oil partners. Remember I said the oil partners in their profit sharing ratio. Okay. And then you go to the capital account and you credit the oil partners. You credit the oil partners in their profit sharing ratio. So what you would have debited here with, so we have Layne and we have Hart. So we only have two partners. So you debit here and then you come here and you credit Layne and Hart for the figure there, and that's it with respect to goodwill. Now, is that clear? Is that clear?
Yes, ma'am.
Okay. Rakim is okay. Say yes, please. All right. Now, when there's a difference now is when it is not maintained. So you have a difference when it's not maintained. So we have another question called Gill and Taylor. In Gill and Taylor, the goodwill account is not maintained. So you have a situation when it's not maintained, the goodwill account is, the goodwill will be shared to the existing partners in their all profit sharing ratio. So that's how you would share it first. You would share it to the existing partners in their all profit sharing ratio, and then you would turn around and share it again to the new partners in their profit sharing ratio, right? And when you do that, it kinds of like close the goodwill account off the books of the business. So therefore there's no balance because the debit side and the credit side becomes equal, and it gives you that net effect, right? So it tells you the net effect of the goodwill always equals 0. Some partners will be compensated by charging the other partners. So with respect to when it is not maintained, the goodwill account is debited in the all partners profit sharing ratio, and then it is credited in the new partners profit sharing ratio. So if you are debiting and crediting the goodwill account, it means similarly that the capital account is going to have goodwill on both sides of the capital account as well. But we will see that as we go through. All right, but let's look at the fact of it being maintained. So it being maintained, so let's look at I know some of this may be going over some person's head, but they may not say anything. So here we have Layne and Hart. The goodwill is $28,000. So the goodwill is $28,000. So here we will have capital, wrong thing, capital accounts, and we have Layne. The goodwill is $28,000. The all profit sharing ratio is equally, so that's a half for Layne. So half of this $28,000 is Layne, so that's $14,000, and the other half, $28,000 times a half, that's $14,000. Hart. So you get 28,000. So our debit side is 28,000. So then we will get a balance carried down on the goodwill account of $28,000.
Mom, I had the right balance, but I just put it in as a whole. I didn't share it.
Well, you didn't share. You just put 28,000 here, and you call it capital. You call it details capital.
Yes, please.
If it was a sole trader, you could have done that, because let's say it was just Layne. You could have said capital 28,000 and then go to Layne capital account and put the $28,000 because it's a sole trader. But because it is a partnership, you have to split it between the two partners. And I think we are going to come across something like that with a sole trader, where when we come to amalgamation, this is what you have to understand. This is why I'm going to encourage you to try to understand the concept of revaluation and goodwill, because the concept of revaluation and the concept of goodwill comes back in things like amalgamations in that topic when businesses are merging. So you can have a sole trader and a partnership merging, but we're not going to get into that. So these concepts come back. So you need, especially with goodwill, you need to understand how to prepare the goodwill account and the capital account when the goodwill is being maintained on the books of the business versus when it is not maintained. Okay, so we have here debit the goodwill account for Layne 14,000, Hart 14,000, and then we go to the capital and we come here and credit, say goodwill 14,000, Hart 14,000. That's what we do there, right? And that is the capital account so far for the partners. And as I said, capital account so far for the partners. Any questions? Any questions? chat. Okay, Rakim said no. Okay, so there's no other person, no questions? Okay. We're gonna get how y'all just know. Right. So those are this is the capital account so far for Layne and Hart. That you all are seeing it well. Make sure that you all are seeing them very well. So this is Layne and this is Hart. So if you're working in spreadsheet, one of the things I'm talking about when you have to do work and submit or anything like that, if you're working in spreadsheet, one of the things that you can do with your spreadsheet, because if you look here, this is how your spreadsheet normally appears. So what you can do, this here, the price sheet normally appears like this with everything spread across, and most of the time persons do not know whether they are on one page or two pages. So because the spreadsheets like that, they just go straight across the screen, typing, and then when they convert maybe to a PDF or something like that, half the T account is on this page, and then the other half of the T account is on the last page, and you're kind of like trying to piece a jigsaw puzzle together when persons do that. So when this is a by the way something, when you're working in spreadsheet, to know if you are on one page, what you do is you click here view, and you click page layout, and when you click page layout, you will see that this is one page now. Right, so this is one page. So my revaluation account and my Goodwill account is on one page, so you can see that is one page, right? And then when I did the same thing here for my capital accounts as well, but then what I did, because it spilled over, because it was portrait, let me teach you all something. Portrait is when the page is like this. So my capital account is too wide to hold on a page like this. So what I did is change it to landscape, which is like this, so that my entire capital account inside of the spreadsheet holds on one page, holds on everything belonging to the capital account will hold on here. Okay, so you will see that is like that. Okay, and I do the same thing with the current account. All right, so I just wanted, that is a by the way Excel lesson. Y'all will get to do Excel when you do 203 and 204. All right, so that is that. So we've completed the revaluation and the Goodwill accounts, and we are now going to look at the statement of appropriation. Not just the statement of appropriation. We're going to look here at the income statement / statement of appropriation for Layne and Hart. So this is where we're at today. All right. Any questions at this stage? Any questions? Let me see.
No, ma'am.
Okay, no, Natisha said no. Okay, somebody said they can't see my screen. Okay. All right. Yes, please. Somebody's raising their hand. Who's it? The person that raised their hand. Oh, Shamar. Yeah. Go ahead, Shamar.
Just going back to the revaluation account. So Layne, how come it on the credit side?
How come Layne is on the credit side on the revaluation account? Yeah. That's a good question, Shamar, because when you look at your question in the question on the paper, in your trial balance, land is currently $100,000. Okay.
Yes, please.
So let me come here and draw here. So I'm going to draw here, and I'm going to show you the land account, what they're trying to show you. You have, this is the land account here. Lay that plate there. So this is land, right? And the opening balance on the land account. So the balance brought down on land based on the trial balance is $100,000. So that's what it is. So then when you get to note number 2, it says on Hart retirement, the following assets were revalued as indicated. And it said the land was now $108,000. So it means now the land value has gone up. So that means the new balance on land, the closing balance on land, the balance carried down, or if I had to say revaluation, closing balance on land is $108,000. That's how much the land is now, right?
Yeah.
Good. So my credit side is $108,000 for land, and my debit side is only $100,000, but my debit side is supposed to be $108,000 as well, because my total debit is supposed to equal my total credits. So if this is 108 and this is only 100,000, it means then that I have to debit here for $8,000. Yes, to make this side 108. So my details here will be revaluation. Okay, so this is, yes, please.
So if something increases, it more than likely it's going to go on the credit side. Or the
the revaluation account?
Yeah.
If it is an asset.
Okay.
But if it's a liability, it's not going to do that.
Okay.
Right? So you have to understand the debits and credit with relation to assets and liabilities. So the land here, the 8,000 is on the debit side of the land account. So that is why when you come to the revaluation account, the $8,000 is on the credit side to complete the double entry.
Oh, I understand.
Okay. The other person I said they understand. Who's that person?
Me, ma'am.
Like, no. Oh, okay. But you have to understand, if it is an asset that is increasing, because the increase in asset you debit, so therefore the revaluation account will be credited. But if the asset is decreasing, it means that, because if you look at buildings went down. So buildings were decreasing. So because buildings were decreasing,
then it will go to credit. So
yes, because the revaluation account is debited with the decrease, and the buildings account was credited.
Okay.
So you have to understand the double entry. So if it's a liability now, if the liability was increasing towards to increase a liability, you credit. So if the liability was increasing, you will credit the liability account, and the revaluation account is debited. Right. So you have to understand the double entry. Okay.
All right. Thank you, ma'am.
You're welcome. Very good question. So I'm going to pause a minute.